The following is a pre-recorded show. Welcome to Winning in Retirement with your host, Brian Akers, certified financial planner professional and founder of Akers Financial Group. Now, helping you win in your retirement, here's Brian Akers.
Welcome to Winning in Retirement. I'm Brian Akers, certified financial planner practitioner from Akers Financial Group. Today, we have a great show for you. This show is actually our mid-year review, and we brought in Mark DiOrio, Chief Investment Officer, the CFA and MBA, all kinds of letters after his name. Mark DiOrio from Brookstone Capital Management out of Chicago. Welcome to our Baltimore station here. We're glad you're here. Good morning there, Mark.
Morning, Brian. Happy to be here.
Yeah, it's great having you on the show. So Brookstone Capital Management is where you work, and you're the Chief Information Officer there?
I am. So Brookstone was launched in 2006, and we are a dedicated investment manager, somewhat behind the scenes, and we work directly with like-minded advisors and to build out an entire investment platform. And so I've been in the business for over 20 years now. And I've kind of come up through the ranks to starting in what you start in is investment research, and then you go into equity and bond research, looking at individual stocks or individual bonds, also known as credit research. And I know that sounds boring, but that's where a lot of analysts actually cut their teeth, really getting into the nitty-gritty of individual companies. And then from there, I went on to building portfolios and had a number of different positions as a portfolio manager and building asset allocation models.
Sure.
And then from there, I joined up with Brookstone in 2015. So it's been over 7 years now, and we've seen fantastic growth. We've grown from about $1 billion to $8 billion in assets under management. And it's been quite a ride. And I like to think that a lot of my time in the markets over the last 20 plus years has been bookmarked by many, many crisis events, not unlike what we're facing now, just a different type of event that's popped up into the market. So every couple of years, it seems like we have a new market challenge to battle through.
Yeah, well, that's been the story of the markets throughout my career. I've been around since 1987, so imagine one of the first things that occurred was October of 87. So Mark DiOrio works for Brookstone Capital Management. They're a third-party money manager that at Akers Financial Group. We use that for our clients. Because one of the key pieces of doing full financial planning and implementing that plan is managing that money in a conservative way to make that money last a lifetime, through how we allocate to how we invest on a day-to-day basis. So it's really good to have Mark DiOrio on our show today. This show we put together is truly a review of what's happened so far, and then we're going to get into the outlook of what we think is going to happen over the rest of this year and what to do about it. You know, there's all these things and questions going on, and so people have this in their mind, what should they do? And so we just start some basic things. So Mark, in 2022, starting January through June 30th, could you give us a little summary of what you saw?
Well, I'd like to kind of forget the first half of the year, but
we could do that and just move right on. That's fine.
But to put it in perspective, we have seen a reversal of many of the policies that were put in place to battle kind of the COVID pandemic era and get us through that. But what I mean by that is a lot of the fiscal and monetary stimulus programs that were put in place really to support jobs and the economy to get us through the shutdowns and kind of a very uncertain environment of how everything would play out and reopen. And so now that we've had this reopening event, we're in a position where we're dealing with the leftover of inflation and maybe too much stimulus efforts out there. And so this is just a reversal. And the markets have really had a challenging environment for the first 6 months of the year. Both stocks and bonds are down. And in fact, bonds are down, and those are usually investors' conservative or thought of as conservative investments, down the most that it's ever been down intra-year in the last 40 years. So they've had quite a big decline as well. So this first 6 months, very atypical. I would say this is the second deepest drawdown for a typical balanced investor, kind of 60-40, 60% stocks, 40% bonds that we've seen over the last about 50 years. Yes. So that's very atypical.
Yeah, Mark, when you're saying about 60-40, you're saying 60% in stocks, 40% in bonds, and that's the index you're talking about?
Yes.
Okay, so you're basically comparing a conservative asset allocation, which might be typical of target date funds and things like that they'd put stocks and bonds in that kind of mix.
Correct. And so that's kind of the standard benchmark. And part of our discussion, and Brian, I know we've talked about this many times, and I know you contemplate this in portfolio construction, which is that traditional 60-40 with interest rates so low and valuations a little elevated going to get you to your goal? So do you just want to stay with 60-40, or do you want to build in where you enhance the opportunity set and incorporate that into your portfolio construction?
Yeah, absolutely. So I guess my opinion is that the bonds it's almost obvious to me that rates were going to move up. And so we've had a consistent side of making our fixed income protected through the use of laddering of fixed annuities and fixed index annuities has been our answer for years, which means on a downturn like this, we don't experience the downturn at all. And that's been a big difference in portfolios that we design. And then that makes us actually have the portfolios that you work with at Brookstone Capital Management, our core and satellite portfolios. We truly have that in majority of stock allocations.
Definitely. I think a lot of investors understand that stocks are a little more volatile, of course, than bonds, but they're always going to be volatile. But over time, they've definitely compensated investors for investing in equities. It's different with bonds, and we spend a lot of time talking about this and thinking about this and incorporating new strategies to address the ultra low interest rates and what that means going forward. In the 80s and 90s, you didn't really have that. And even in the 70s, you really didn't have these low interest rates. You were earning a very good positive return on conservative bonds. Today, that's not the case. So it definitely poses a unique challenge for investors going forward. And that with this inflationary environment, you're just not earning an interest rate that's compensating you for the inflation rate, which you have historically achieved.
Are you saying we historically achieved that rate with what kind of bonds are you talking about there?
With bonds, think of core bonds, so a combination of treasuries and corporate bonds. Mm-hmm. Today, that's definitely not the case, and that may not be the case for years to come. And we're not overly negative on bonds. It's just to put the issue in perspective, saying that it's a different issue. You're just not managing volatility risk, which is a short-term risk. You're also managing the long-term inflation risk.
Sure.
And you see that kind of crop up in a year like this in the last year or so.
Absolutely. Now, the market itself over the first 6 months are down in almost every category.
Well, June was a remarkably challenging month in particular, where every industry group we follow in the market was down. And so typically that's not reflective of individual business conditions. And the energy markets were holding up pretty good because oil was running high and natural gas and so forth. That actually came down as well pretty quick. So June, you saw everything really kind of succumb to the overall macro backdrop, which is the Federal Reserve raising interest rates and really trying to tighten monetary policy. And of course, fiscal policy has waned since the impetus from the COVID era.
Yeah, so basically in June, it was a question of did we lose a little bit or a lot, depending on where you had your money, correct?
That's right. So everything really just succumbed, all the financial assets, just that tightening of monetary policy where they're trying to pull money out of the system to get a control or get a handle on inflation and to slow that down, because that just causes a challenge for cost of living and things like that. So it's a little different than a financial markets challenge that's really related to the overall economy.
Sure. So what else happened during the first half of the year?
Well, overall, the markets were more volatile. It was the fifth most volatile year, on pace for the fifth most volatile year in the last 30 years. So we've seen markets swinging back and forth. But the main driver has been the Federal Reserve, which is the central bank of the U.S., raise interest rates to slow down inflation, as I was mentioning. That's the main policy driver impacting markets. So they now have continued to raise rates, and it's now above 2%. What they raise is the short-term interest rate. It's called the federal funds rate, which is the rate that banks lend to each other in the overnight market. And the idea there is that that'll kind of creep out into the system as banks decide maybe not to loan, or it becomes more challenging to loan, or rates have to move higher. So it's less appetizing or less appealing to borrow. But the big one was, of course, mortgage rates shot higher, all the way up to almost 6% for a conventional mortgage. And that's the highest it's been in about 15 years. So that's definitely going to play a role in affordability of homes and maybe home prices.
Wow. Yeah, I'm just trying to hear all that information. I'm trying to apply what does that mean to the average consumer, the average listener out there? How would you apply it to what's going on in their lives?
Well, a couple of ways. From an investment perspective, almost what we were talking about before is what components are you building into your portfolio? If it's just traditional stocks and bonds, well, you could contemplate that, well, stocks are going to be volatile, but the bond side of the portfolio isn't going to necessarily keep up with the inflation rates. Inflation has been, up to this period, below basically the target for the economy, the Federal Reserve's target for the economy, about that 2% range. So we've had a long period where inflation has undershot expectations. Now we may be in a period where inflation overshoots anticipated or expected and preferred inflation rates. So you need to be generating kind of unique sources of risk and return. On the flip side, it's just have to balance cost of living, as I mentioned, those types of shocks that you see where you still have supply disruptions impacting prices. We do think that's starting to alleviate really beginning in June with that major adjustment. You saw it in stock prices first, but I think we're going to see it reverberate throughout the economy.
Wow. Yeah, supply and demand, how does that affect what's going on?
So we've had a number of supply disruptions, and I think that's been the big driver in terms of where you see these pockets of maybe shortages in semiconductors, for example, and you can talk about maybe delays in new cars,
Sure.
and new car deliveries, and the elevated prices of used cars, which is a bit of a head scratcher, where you'd say that's not normal. You know, a used car shouldn't be selling at the same as a new car. But because there's such a delay with new cars, used cars have been very elevated. And then we still see kind of the hangover from elevated housing prices because you've had a big jump, and that was partially due because interest rates were in that 3% range for a conventional mortgage, but now they're in that 6% range. So, and I think there was also a bit of a supply and demand mismatch at that time too, where the supply of homes were very low relative to some of the buyers out there. And then global supply chains, I think, are going to go through a fundamental rethink this entire decade. It's not an overnight thing, but China's still going through different lockdowns as it goes through their economy. So they have a different policy. So that can disrupt supply chains into the U.S. So I think you'll see a little bit of impetus there. We see a semiconductor stimulus plan going through Congress right now, which I think would be great. It's a key component to the U.S. to really think about onshoring some of our supply needs.
Absolutely. Well, this quarter has been flying by. For the listeners out there, as you think about all that's going on, what you want in your retirement is to have basically a worry-free retirement where you worry each day about where you should drink your morning cup of coffee instead of worrying about your investments and what's going on the markets. Now, we've been covering the markets today. The idea is good information helps you make good decisions. So in retirement, we want to make good decisions for your family and for your finances. And that's what we do at Akers Financial Group. It's not too late to sit down with one of our team of advisors and talk about your exact situation. That free meeting can then happen online through Zoom, or it can actually be in person at one of our offices. You just go online to akersfinancialgroup.com or give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We will call you back on Monday to schedule a time to set up that initial free meeting with one of our team of advisors. So go ahead and call 833-946-7384 to start planning for your retirement now. Is there such a thing as a short recession? We'll answer that in the second quarter in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. Welcome to the second quarter. I'm Brian Akers. I'm certified financial planner, practitioner, president of Akers Financial Group. On our show today, we have Mark DiOrio from Brookstone Capital Management. He's been talking a little bit about the market over the first 6 months of the year. And Mark, you ready to go here in the second quarter?
Let's do the second quarter, Brian.
Hey, all good, because I'm ready to ask a few questions. We're going to try to look at opportunities, see where the market has been, and what you think is going to be happening here. What I wanted to do is start with a pretty simple question, I hope. Is there such a thing as a short recession?
A recession is generally defined, and this is a broad thumbnail sketch. This isn't the absolute definition, but it's 2 negative quarters of GDP or economic growth. And so it's certainly possible you get a shallow recession. So in the global pandemic in early 2020, you had a very sharp, deep recession where you had job losses obviously accelerated when you had the shutdowns. In this case, we might be seeing a slowdown start to take hold. And I mentioned last quarter, we saw June was really that real turning point where you saw almost the economy in every sector really start to slow down amidst the number of supply shocks, as we mentioned, the tightening of monetary policy. And one of the keys that I didn't mention, and I was saving for the second quarter, was some of these disruptions in the commodities markets where you had the Russia-Ukraine invasion and you saw commodities really jump higher. But that's all almost fully reversed now through June and to start the third quarter, really suggesting that we might have gotten past that peak kind of demand and supply mismatch. And so that demand could be slowing. And in this environment, one of the keys we're looking at for maybe you have that slowdown because affordability just got too high, and maybe some of the pent-up purchases and some of the excess stimulus funds have run down already, so you don't have that excess demand. But you see employment really, really stable right now, and you still see a lot of job openings. And that could come down, but there's still a different type of supply mismatch, and it's actually on the positive side in the employment picture. And so usually during a recession, you see unemployment start to really pick up. But here, because job openings are very wide, and granted, that's a blanket statement. They're in many different sectors. If employment stays pretty steady here, which we expect, and not a big unemployment kind of surge, we think that it would definitely be a minor slowdown or a shallow, short, brief recession.
All right, that sounds like good news, but is that what the Fed needs to happen for inflation and interest rates to sort of put a halt here? What's going on?
So the Federal Reserve has talked about targeting inflation, and by targeting inflation, bringing inflation down, they are raising interest rates, and they don't control supply. They do have an impact on demand, though, and so what they're trying to do is cool or slow down demand. Now, historically, that means, okay, you have to take the economy kind of from an overheated position into a recession. But that's not what they're trying to do. What they're trying to do is normalize policy, kind of bring the economy back into alignment after this major kind of unique event, hopefully one-off event that we had, the global pandemic, where you put in policies. Now you have to reverse those policies. We're going through that right now. And they're not trying to overly tighten or overly take down the economy. They're just trying to bring it back into alignment by cooling down inflation. And they're talking about this, and they're calling it a soft landing. And a soft landing, I think it's okay if you have that shallow kind of negative year over year or quarter over quarter GDP growth. It doesn't, without unemployment claims really surging and having real dislocation in a negative direction in the jobs market, I think they can pull that off. And so recent commentary out of the Federal Reserve has been that we're close to neutral on policy. And so they don't see themselves having to raise rates too much. And we're getting very close to what they call the neutral rate. And the next meeting for the Federal Reserve is not until mid-September. So they have a good almost 8 weeks, 2 months of data to really gather and make sure that they're making the right decisions.
Because when I hear from individual investors, the people that have not invested for long, they get very panicked experiencing their first downturn. And then from what you just said, it sounds like we could be sort of the worst at the moment that we've seen. Or June was maybe the worst that we're going to see, or is that sort of to be seen in the future or to hear from in the future?
I definitely think June was one of those points where you say, you threw the baby out with the bathwater, so to speak, where everything got hit because maybe selling overwhelmed the market in that moment in time. But as the dust settles, investors will be able to act a little bit more rationally, a little more calmly. This was just a very fast-moving market for the first 6 months of the year. And this is really a condensed business cycle. Traditional business cycle you'd be about 4 years. Here we're in this 2-year cycle, which is you go down into a recession during the global pandemic in early 2020. Then you bounce back very sharply and overheat and maybe overshoot on some prices. And now you come back and are in that normalization or cyclical slowdown phase. So it's been a very condensed cycle this time around.
Typically, when I talk about investments and I think about business cycles, I'm thinking that if people want to invest now, they need to be in for the long term. But when I think long term, I have a certain number of years in my mind. What do you think about when you think long-term investors?
I think about if they're balanced investors. In other words, if you're all in stocks or an aggressive investor, I think you need a little bit longer time frame. That's what the data would suggest, that you can see downturns, and let's take the global financial crisis as an example of a major one. It took about 5 years for equities to recover. If you were more of a moderate type of investor, you could think about 3 to 5 years in that recovery phase. So to me, it depends what your risk profile is, and then secondarily, how you're implementing that portfolio or what you're building that portfolio with. So if you have a few other diversifiers and add those unique opportunity sets into a portfolio, you could really have a recovery and be able to moderate your portfolio so it's enduring and can manage through these environments in a much more smooth manner.
Yeah, so what I'm hearing is that we've been through some really tough times, especially in the first half of this year. Is it coming off of like a bubble of 2021? Or how do you think we'll be able to explain 2021 when we look at the chart over the long term?
I think it'll go down as a little too much stimulus, both monetary and fiscal stimulus, getting through really this window of time where you have these supply disruptions that really we haven't faced in 30, 40 years. And I do think it'll set off, as I was mentioning in the first quarter, kind of this idea of let's think through supply chains and what we need in this environment, and maybe onshoring. And remember, we've gone through 30 plus years of offshoring. Maybe we need to onshore some capabilities.
Yeah, onshoring is what you mean by that is bringing jobs back, manufacturing back to the United States. That's what you're trying to say there.
I am. And it's not an overnight process. I mean, this will play out over a decade, maybe even longer. So I think it's just critical rethinking of supply chains right now.
I think of chip production. I think that is one of the pieces that hits in my mind first when it comes down to producing in the United States and changing what we do and how we do it.
I agree. High end makes a lot of sense here, and there's a movement in Congress already to support those efforts. And so I think that would be a very, very critical first step. And I think that'll just blossom from there.
Can you explain a little bit about growth investing versus value investing and what might be the better area to be in currently?
Sure. Value investing is kind of a traditional approach where you're looking at what I'd call classic companies that are trading at valuations below where the overall market is trading at. And the largest sectors, or the most commonly referenced sectors in value, are consumer staples, financials, and energy markets now, the energy sector. Growth, you have companies that are trading or that exhibit growth aspects that are growing much faster than the overall economy. And generally that's in the tech sector, or now the communication sector, or the consumer discretionary sector. So very different. And you've had in 2020, 2021, on the rebound, you had the growth sector really outperforming. Here, as we started to get into a slowdown and inflationary environment, you've seen value outperforming. And so these go through different cycles of kind of when the sun is shining on which area to allocate to.
Absolutely. So investing like this is why we use Brookstone Capital Management as one of our portfolio third-party managers. So Mark DiOrio runs different portfolios for our clients at Akers Financial Group. And we use Mark to manage some of our stock baskets. Some are designed towards growth, some designed towards value, some dividend. There's a lot of choices. The approach is more of a core investment and satellite. And that's what we've been doing at Akers Financial Group, because we understand that the best part of retirement is getting your time back, where you decide how to use your time. Before retirement, your time is tied up with other commitments, mainly your job. A lot of that goes away at retirement. Your time is now consumed by things that you want to do. It's so easy to begin winning in retirement. Go to our website at akersfinancialgroup.com. Scroll to the schedule a meeting section and let us know you'd like to schedule your free consultation with one of our team of advisors. That's akersfinancialgroup.com, or you can call us at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to akersfinancialgroup.com or call us at 833-946-7384 to start planning for your retirement now. Are higher interest rates always good for savers? We will discuss in 2 minutes as we begin the second half.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Welcome back to Winning in Retirement. I'm Brian Akers. Here with me today is Mark DiOrio. Mark DiOrio is the Chief Investment Officer from Brookstone Capital Management, and he helps Akers Financial Group with our third-party money management, and he's done a great job over the years for our clients. And we welcome him back here to the second half of our show. You ready to go, Mark?
Let's do it, Brian.
Oh, good. Now, so far, the talk we've had has seemed very positive about what's going on to the future, even though you were started out the show very sort of negative about what happened in the first half of the year. So here in the third quarter, just a simple question to start, and that is, are higher interest rates always good for savers?
So it depends why interest rates are rising. And so for reference, when interest rates rise, bond prices decline. And typically interest rates are rising because either you see faster growth or faster inflation. And in this environment, we've seen the Federal Reserve move monetary policy and interest rate policy from very low levels, basically zero, and now move it up to over 2% on overnight money. So savers, traditional savers, think savings accounts and CDs, are starting to see some interest trickle into those accounts. But I would be very cautious when you're just looking at interest rates and are they beneficial. Sure, you like to get some interest on your savings, but it's really what is the actual return in context of preservation of purchasing power. So if inflation's at 5 or 9% and you're earning 1 to 2% on your savings, well, it's not going to overcome. So it can kind of mask what the actual issue is. And what we've been saying is that, geez, in this decade, we've already started in the fact that interest rates, and especially for savers, are below the rate of inflation and probably for some time. And so your purchasing power is actually going to decline over time. So I wouldn't take that much comfort, although it is a little bit relieving for savers in particular. But you may be missing the bigger picture. Whereas even though over the last 20 years we've seen a global financial crisis, a global pandemic, a number of bumps along the way and uncertainty, stocks and balanced portfolios and investors from conservative to aggressive have all outperformed inflation. The flip side is savers and traditional savings accounts and CDs have not, and that's because interest rates have been below the rate of inflation. So I'd keep that in mind when you're evaluating just whether it's just good or bad on the interest rate front.
Yeah, when I was thinking about good for savers, because for those people that are in debt, they're seeing that interest rates are starting to rise, and if we want to get a new mortgage, and those have really jumped up, and we're trying to see really as a saver, you should start seeing some extra return on your actual cash But cash has never really been the long-term answer to beat inflation and to keep up with the cost of living. When you talk about your retirement years, you really need to diversify your portfolio and have other investments other than cash to be able to make your money provide for you for those retirement years.
Definitely. And I think that's the number one reason to build an investment portfolio is the preservation of purchasing power over time. And so volatility gets all the headlines and day-to-day news of what the market's doing, but it's that inflation risk over time that's really your bigger risk to really contemplate. And so adding different pieces to your portfolio to contemplate that risk. And I know, Brian, when we talk about portfolio construction and you add different pieces to the portfolios for your clients, it's really thinking not just about the moment in time, but also how does this addition help the portfolio overcome and achieve that preservation of purchasing power over time.
Yeah, at Akers Financial Group, we try to think differently about retirement years because it's about providing that income for a lifetime. We don't have a defined time scale where we say, well, this timeline is going to be 20 years, 25, 30. We got to plan for almost 30, 40 years of retirement at an income level that's rising and to be able to keep up with everything that might happen in life because that's a variable because life changes. So that's what financial planning is all about. I don't know how people invest without the planning. The planning is so important to understanding everything involved. So the more tax efficient, then we don't have to take as much risk on the portfolio side because we're not giving away a third of that money to the Fed or state government for taxes. So when I'm thinking about portfolio and trying to design for my retirees, and I'm thinking about opportunities in the markets today, I want to get your opinion on, let's say a client's retiring, they're trying to bring their 401k to an IRA, and they really, really want to diversify in a far greater way than their 401k would offer. What are some ideas that you would want people to think about investing in, even this year, when they talk about retirement saving and investing?
Sure. And in the 401k plan, which are great for savers, but as you get close to retirement, there's some limitations, either the menu that you have for selection, 2, maybe the lack of guidance, 3, a lot of money's in target retirement date funds, and their main goal is just they're a balance between stocks and bonds traditionally. And then as you get close to retirement, the general idea is that they're selling stocks and buying bonds. Well, we've made a really good effort to say, well, you want to look at the opportunity for the asset class as opposed to just rely on that systematic program that just says we're selling stocks, buying bonds at these low interest rate levels. We think you want to take a little bit more sophisticated approach to that and really thoughtfully think through what could be added and enhance your opportunity set. But I would say one of the things right now we definitely think are applicable today and into the future is looking at a classic dividend strategy, dividend stock strategy. They're currently yielding, most classic blue chip type dividend stocks are yielding above where current interest rates are or what bonds are paying. You get the potential for stock price appreciation over time. And third, what often goes missed is that companies raise their dividends to shareholders over time. So year in, year out, or every few years, they'll raise the payout to shareholders, and you don't realize it, but that's a decision not made by the market. It's made by the board of directors of the company and a direct payout from the company to the shareholders. And then from there, we look at, and I know, Brian, you and I talk about this, is, you manage that portfolio, see what opportunities are out there in dividend stocks. And in this environment, where a lot of stocks sold off that maybe didn't deserve to sell off, you're getting some pretty good opportunities here. So they really play can play a pretty critical role for the retirement investor that often goes overlooked, and definitely goes overlooked by Wall Street because no one's really making money providing that advice. There's no commissions, for example, on dividends. That's a direct cash flow and a direct benefit. So that's definitely an area we look at. And then we look at some options enhanced strategies and how to blend that into a portfolio. And those are strategies that you don't have to know everything about options. We're reviewing those and going through a due diligence process and making approvals at an investment committee level that say, yes, individual investors can put this as a component of the portfolio and it'll play a role. One of those would be covered call writing strategy, where you're picking up excess yield. And when you have a volatile market, you see a lot of yield coming off of that. And I won't go into and bore everybody about options, but it's just one of those unique strategies that if you take the time to look at it, there is a way to apply that and also invest in it in an investment or investor-friendly investment vehicle like an ETF, an exchange-traded fund. So you don't have to trade options and go down that route. It's really looking at some of these investment vehicles that aren't traditionally available, let's say in the 401k, and now all of a sudden they're available in a managed IRA account.
Yeah, I know with the option trading that can be added to portfolios, it's typically to lower the risk. It's not to raise the risk. Some people are out there trading options trying to make double or triple or even more on the return side. We're really trying to shield the risk level with that.
Definitely. I think that's an important point where you hear some of these those ideas out there, but we look at options as just a way to reduce risk or really deliver a defined outcome, which is either maybe excess return or using something called buffered strategies or buffered ETFs, which have a way of limiting the downside participation in stocks. And so that's right along the lines that you're talking about, maybe defined as a hedged equity. Just a way to participate in equities with less volatility. So an easier path through that retirement.
Yeah. So investing right now, what happens is if there's money available to invest, I've been recommending that people consider dollar cost averaging into the market over the rest of this year. What's your thoughts on that concept?
Well, I think you know, there's a couple of things you know. Stocks have declined about 20% in the first half of the year.
Right.
That's a pretty big decline over 6 months. But either way, they're 20% off their highs. And a lot of high-quality stocks, even the big tech stocks, are 30% off their highs. And so you're investing when the market's in a downturn, and historically over time, it has recovered. So you get all that recovery and then gains beyond the new highs over time. So I definitely think that's a good way to say, look, we're in a challenging macro backdrop right now. There could be more volatility along the way, but as you're putting money in a dollar cost averaging approach in, you're going to get the lows, but also the volatility isn't going to affect you too much because you're taking advantage of it while you're getting investing here. And it does get easier. In other words, the macro backdrop will not always be this challenging.
Yeah, that's good advice, because at Akers Financial Group, we really want our retirees to win in retirement. Winning in retirement, to me, is keeping the money you have, having your income planned for, and understanding what's going on so you know that you have a plan for where you're going to get your checks. It's so valuable for retirees to know where the money's coming from. At Akers Financial Group, we're a local, independent. We don't report to a big company on Wall Street. We report to you. We do have offices in Forrestville and Lutherville and clients all around the country. It's so easy to begin winning in retirement. You can just give us a call for a free consultation with one of our team of advisors. Give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting. Go to our website, akersfinancialgroup.com, or give us a call at 833-946-7384 to start planning for your retirement now. Okay, we've talked about where we've been and where we are now, so you'll want to stay tuned for the fourth quarter because we're going to talk about where we're going, and we'll do that in just 2 minutes.
You're listening to a pre-recorded show. Welcome back to Winning in Retirement. Call 833-WIN-RETIRE now to schedule a visit with Brian and his team and begin winning in retirement. Once again, here's Brian Akers.
Thank you, Mr. Announcer. Just like the announcer was saying, welcome back to Winning in Retirement. I'm Brian Akers, President and founder of Akers Financial Group, and we welcome you back to Winning in Retirement. Today we have Mark DiOrio, Chief Investment Officer from Brookstone Capital Management out of Chicago. This show today will be on our website under the radio tab. I will be there by Monday for you to check out and to listen to different parts about what's going on in the markets and understanding what our opportunities might be for you as you talk about your retirement years. Also on our website is a webinar tab. Mark DiOrio, myself, Alex Monk, and Bernie McVeigh, all from our investment committee, put together a webinar, a video where you can actually hear each of us talk about the market. And Mark DiOrio has a bunch of slides to go with his outlook and look back on the mid-year review. So that's a webinar that it will be posted on akersfinancialgroup.com for you to check out. Sign up for that and actually watch that video online. It'd be great for you. We do thank you for listening for the first 3 quarters. Here's the fourth quarter. The fourth quarter is always winning time. How you doing there, Mark? You ready to win?
I'm ready to win. That sounds like a great webinar, Brian. A lot of all-stars on there.
It's a bunch of superstars. I'm sort of just the MC in between, which is nice. You guys carried all the load for me. The best thing was some of those charts you did were incredible. I thought that'd be something everybody might want to, if they're really into investments and watching the trends and what's going on, they might want to see what you had to say about what's been going on the first half of the year.
Yeah, definitely. And I think charts help put things in perspective and maybe historical context as well. And they also help guide our decision-making framework where we're try to be as objective as possible. And while we have a narrative and a view on markets, it's always helpful, I think, to look at charts, look at the data, right, away from maybe some of the narrative.
Yeah, I know one of the charts was you comparing the S&P where it is valuation-wise at the end of June compared to where it's been overall, and how it is maybe not undervalued, but more fairly valued than people might think.
Yeah, definitely. Even though we've had a pretty good run over the last number of years, this decline has really put stocks in a position where they're actually trading the index, the S&P 500, trading below its average, its 25-year average PE or price to earnings ratio. I think that surprised a lot of people.
Right.
And so that's because earnings have held up. And even if you look at the big cap tech stocks that have led and kind of have elevated valuations relative to the rest of the market, they're not as demanding as people think either. Those are obviously top tier type of companies, but they're all trading at valuation levels below where they were in 2020 before the pandemic and any stimulus hit. And so that's a pretty remarkable valuation, I think, nugget to say, well, wait a minute, let's take a rethink this of where we've been. There's been a lot of noise over the last 2 years, continue to be this year. But if you take a look and look at valuation, it's not nearly as demanding as it was, and maybe even present a lot of opportunities here going forward.
Yeah. So what I'm hearing you say is this: is as our listeners are driving to or from their golf event, or maybe to their boat, or on vacation. Because I was out in Ocean City last weekend, and I could hear a radio show down there. The idea is, as you're driving and listening, you're thinking about investing and what you should do. I think what Mark is saying is that it's not time to panic and run for cash. It's an opportunity that you need to evaluate for long-term investors to buy into a market that long-term you might be able to make some of this money back that the market has lost year to date.
One of my favorite indicators that I look at is something called sentiment, investor sentiment. And that is a contrarian indicator, meaning when there's a lot of optimism, there's actually elevated risk in the market. But when there's a lot of pessimism, there's a lot of opportunity in the market. And so now we're seeing levels of pessimism about the economy and about the markets that we typically see and have seen over the last 10 years, where we've seen these cyclical kind of good entry points. You don't know if it's the bottom or where necessarily, and you won't know where the final low is until hindsight, but you know in the range where you're at. And so from a sentiment perspective, we see it really consistent with other areas that have really been good entry points for investors over time. So these are pullbacks, they happen, and investor sentiment is getting really negative, including consumer sentiment surveys. It's slightly different than investor sentiment, but the consumer surveys are really showing extreme negatives as well. I think that has to do with the inflation that has kicked in and affordability and things like that. However, when we overlay that with your forward investment returns, they've actually been remarkably positive going forward when you hit those moments in time. So yeah, I definitely, just what you're saying, Brian, keep that in mind. That's not the time at this point to start to get overly negative and run for the hills.
Now, I was thinking that with the market volatility, there will be opportunities throughout the year where the market does pull back based on some short-term things going on in the market, such as the monthly inflation rate that keeps coming out. I do think things might look a little bit better as oil and gas prices have dropped a little bit, but the inflation is going to be here for a while. The interest rate hikes are happening. All of that are things that can cause the market to go down in the short run.
Definitely. You have geopolitical risks still in play. You have the midterm election cycle to get through this back half of the year. So there's a number of kind of potholes that could pop up in addition to the inflation numbers that you're mentioning. One of the areas, since you mentioned oil, that we had been talking about and mentioned since last year was that although prices, the oil price per barrel got up to where they were pre-pandemic levels, above that $70 a barrel, oil rigs operating were about half of what they were the last time oil was at that price. And so we thought that there was potential for, and sure enough, it happened. It wasn't a prediction. It was just there was potential that you didn't have enough oil rigs operating, and if you had any disruption in oil, it could shoot higher. Well, it did pop higher on the geopolitical tensions and risks that came out, but it's made pretty much a round turn. That's oil I'm referring to, and is now below $100 a barrel, below where it was before Russia invaded Ukraine. And oil rigs have gotten up to the level where they're operating where they were pre-pandemic.
Okay.
So that's helping to smooth out that market as well.
Now, how about international investing? Should we be looking into opportunities now, or should we wait for something to settle out with Russia and the Ukraine?
The main kind of point that we would be looking at is the value of the U.S. dollar. And so everyone talks about that the purchase power of the dollar is declining, and that's so in the U.S. But if you look at it internationally, the dollar is actually very, very strong,
especially to the euro.
Other
right?
currencies,
yeah.
Yes, that's almost at parity and is touched there. Right. But it's been very strong, and against the yen, not to mention any of the emerging market economies. So what we'd be looking at to get more comfortable with international is the kind of turn in the dollar. And that might happen with maybe the Federal Reserve comes out and says we're going to pause or interest rate increases. We've been more aggressive than most international economies at raising interest rates, which is keeping our dollar strong globally. So that's been a key catalyst there. If that starts to turn, you could see international really start to pick up. Their valuations are very cheap, but they've been pretty inexpensive for a number of years. I do think that they will have a pretty big pickup phase at some point here. Very hard to pinpoint, but that would be why an investor would have international diversification, because they could see an outsized return just because valuations are so depressed relative to the U.S.
Yeah, the hardest thing to learn over time in investing is some days when everybody's running out, you got to be running in. And that's a hard thing to do when it comes to investing with your money, because you don't want to work hard for that dollar and then invest it and watch it go down. Now, the reality is that when people are listening to the show, they think about their 401k and how the last statement was way down. And their first reaction is, oh, I don't want to lose anymore. I want to be out. And the thing that I like to try to explain is over the last couple of years, you're still up over that time period. And the idea is when the market's down, we need to keep buying with our contributions, keep contributing, keep putting that money in, but make sure your overall allocation is correct. Now, at Brookstone Capital Management, you have many, many different portfolios that are places to put money. What are just a few of the portfolios that you use in the core and satellite that you might want to mention here as we end the fourth quarter of Winning in Retirement?
Sure. One area that's been very popular from a core perspective, and as you mentioned, we run, I think of building a portfolio from a core allocation, which are core holdings consistent with your risk profile. So we blend asset classes consistent with your risk profile, and then add satellite, either a component or a couple components to really customize that core allocation depending on your investor preference. So that could be for more defense, mitigating volatility. It also could be for more income, try to maximize income for your risk level. And so one of the areas from a core perspective that has done and held up very well in a market like this has been something called our low or minimum volatility equities. It's called our smart beta strategy. And it's a portfolio that's really based on building a portfolio around isolating the least volatile stocks in the market. So you still have equity exposure, but you're doing it with the least volatile stocks. And what the research will tell you is that, you know what the least volatile stocks are? Those are the ones with the most consistent profitability models. Right. So think of the most consistent companies, typically blue chips, not all the time, but those that just are consistent businesses that have proven that they can battle in and out no matter what the macro backdrop is and battle through challenges, just well-run companies. So that one has held up really well in an environment like that.
Yeah,
the important part
that's
is
excellent.
Is that it's designed to do that. It's not going to outperform during a growth-led bull market. It's not designed to that. It's designed to really hold its own throughout multiple market cycles, and in particular, kind of shine when everything else is a little dim at the moment. So that's held up pretty well, and it's done a great, kind of been a great core allocation for a lot of investors.
Yeah, absolutely, Mark. We do thank you for talking today on our radio show about the markets of the first 6 months and some outlook to the future here, and giving us some positive thoughts on ways of investing, and especially about the ideas of the dividend stocks, low volatility stocks, opportunities that are out there. So thank you very much for your time today, Mark. I really appreciate it.
Thanks, Brian. It's great to be with you.
Yeah, no problem at all. And we want everyone out there to win in their retirement by taking advantage of the opportunity to begin planning with us at Akers Financial Group. To schedule your free meeting with one of our team of advisors, go to our website at akersfinancialgroup.com. Scroll down to schedule a meeting section and let us know you'd like to schedule your free meeting. That's akersfinancialgroup.com, or you can give us a call at 833-WIN-RETIRE. That's 833-WIN-RETIRE. We'll give you a call on Monday to schedule your free in-person or Zoom meeting with one of our team of advisors. Start planning for your retirement now. Go to akersfinancialgroup.com or give us a call at 833-946-7384. Thank you for listening. I'm Brian Akers from Akers Financial Group, and we want you to be winning in retirement.
You've been listening to Winning in Retirement with your host, Brian Akers of Akers Financial Group. Brian Akers of Akers Financial Group is a registered representative offering securities through Kalos Capital Incorporated and investment advisory services through Kalos Management Incorporated. Akers Financial Group is not an affiliate or subsidiary of Kalos Capital or Kalos Management and does not provide tax and legal services. Advice given on Winning in Retirement is general in nature, and one should seek further advice from their financial advisor, broker, attorney, or tax accountant before investing. Be sure to read each prospectus carefully to understand all the risks associated with each investment.